Hello, greeting friends. Welcome to the accountancy lessons. Today we'll discuss over the topic rules of debit and credit. But before we go thoroughly with the topic, let's understand about the key terms to be used in this chapter. Starting with the term assets. What is assets? As discussed earlier in the accountancy terms, assets are the financial properties and rights exercised by the business over its properties, over its assets, over its goods. What kinds of goods and what kinds of services they are manufacturing, through what kinds of assets they are being provided in with the business. Now, assets can be of three types: current assets, non-current assets, and fictitious assets. Current assets have examples like stocks of raw materials, which can be realized into cash within 12 months from the preparation date of balance sheet. Non-current assets, which are used for further production of goods and services and which can't be realized into cash within 12 months from the preparation date of balance sheet. Example: machinery, computer, furniture, etc. Then fictitious assets, which are the expenditure which are of enduring nature, giving benefit of more than one accounting period to the business. For example, the advertisement expenditures. Assets have a debit balance, which is an accountancy rule. Now, liabilities. Liabilities are also of two types: current liability and non-current liability. Current liabilities are those which are to be settled within the 12 months from the preparation date of balance sheet. For example, the liabilities or loans given through bills payable. Bills payable is a paper document or a bill of exchange which is issued by the notary public. And non-current liabilities finally, which is to be settled after the 12 months from the preparation date of balance sheet. For example, debentures. We'll study about the debentures in the company accounts. So liability is the financial obligation of an enterprise towards any other person or towards any other company. If our enterprise, for example, if our enterprise has borrowed 5,000 rupees or 50,000 rupees from you, from your enterprise, this means that our enterprise has a financial obligation towards you up to the extent of rupees 5,000 or up to the amount which I have availed from you through a loan. Capital. Capital is the amount invested by a proprietor in the business in the case of sole proprietorship. In case of a company firm, the capital is the amount of shares which he has bought, that is, number of shares into the rate of shares is equals to the capital which is being supplied by a shareholder in case of a company form of organization. So in case of sole proprietor, it is a single person himself who is supplying the capital, and in case of a company firm, it is many of them who are contributing towards the capital of a huge company, that is through the help of shares. Capital has a credit balance along with liabilities. Now, what are expenses and revenues? Expenses are the petty expenditure which are incurred by the business in order to generate revenue. For example, salaries, rent, wages, discount allowed. Discount allowed is the rebate given by the seller to the purchaser for purchase of goods and services in bulk so that his sales can increase. Salaries and wages to the office workers and the laborers involved in production of goods. And there can be other types of expenses as well, like uh, basically depreciation in machinery. This is a kind of expense. Losses can be like bad debts, incidental losses like loss in case of fire or loss in case of sale of fixed assets. So these are expenses and losses. Expenses and losses have a debit balance. Revenues. Revenues and incomes are the amount of money which is generated in the firm, or which is a kind of inflow of money for the firm through the sale of goods, services, or assets. And revenues have a credit balance. So now we have gone through with the key terms to be used in this chapter. Let's start with the concept of the traditional aspect of accounting. Traditional aspect of accounts. But before we start with the traditional aspect of accounts, now please define what is accounts. Accounts is a summarized head of transactions recording similar transactions of a head at a particular place. For example, in cash book you have transactions related to cash only. In purchase book or in purchase account, you have transaction related to stock only. In any personal account, for example, I say Ram's account, you have transaction related to Ram only. Similarly, in case of bill receivable, you have transaction related to the issuing of bills receivable and the realization of bills receivable through receiving of cash respectively. I like to write on the board: bill receivable account, issue of BR, and receipt of cash through BR only. So accounts is summarized head of transactions of a head at one place. So traditional aspects of accounts divides the accountancy term into three parts. First of them is personal account. Second is real account. And the third one is nominal account. Now personal account is further divided into three parts. First of them is natural personal account. Natural personal accounts involves named persons like Ram account, Mohan account, somebody's capital account. So capital account, somebody's capital account can be categorized under natural's personal account. Now, what is artificial personal account? Now, you have read in the business studies first chapter, basic forms of business organization, that company is an artificial person having a common seal. Now, how is company an artificial person? Company is an artificial person because it can be sued under its name, and a company seal is an original authentication by the firm's owners to any deal. So company can be called as an artificial person. Any company, for example, Reliance Industries, artificial. Airtel company, artificial person. So companies and cooperative organizations come under the artificial personal accounts. Now, representative personal accounts. Representative personal accounts represent a particular kind of persons, a particular sets of persons in accounts. For example, if I have to give a rent to landlord, there can be several other people who have to give their rents to the landlords. So they have to classify their outstanding or prepaid rent under their representative personal account, if any. If only representative personal accounts can be classified only for outstanding, prepaid, and accrued income and expenses. So, representative personal accounts will account for outstanding rent, outstanding salary, outstanding wages. Prepaid expense. Prepaid expense will account for prepaid wages, rent, salary, etc. Now, what is outstanding and prepaid? Outstanding is the one which has been accrued but is not being given. That is, which has been accrued but which has not been spent. For example, the rent for 12 months which is payable to a landlord is rupees 12,000, and I have given only 10,000. That is 1,000 per month. I had given rent worth for 10 months. That is, rent up to 2 months is still payable. That is, we have not paid rent of up to 2 months. The rent of that 2 months will be called as outstanding expenses. Now, same applies to the prepaid expenses, but if I have paid rent for up to 2 months of the next accounting year, that is 14,000, applying to 1,000 rupees per month. If I had given rent for 14 months, then the 2 months for which I have given the rent in advance will be termed as prepaid expenses. So outstanding prepaid expenses will be accounting under the representative personal accounts. So basically all kinds of liabilities and expenses of assets like prepaid expenses and outstanding expenses will be accounting under the representative personal account. Now the real account and nominal account section is also combinedly known as impersonal accounts. That is, they don't deal with persons. Now the real account is comprising of assets, like what kind of assets, fixed assets and stocks as well. So real account will comprise of computer, furniture, machinery, plant, stock, raw material, etc., copyrights, trademarks, etc. So these will be coming under the real account. Now nominal account will account for all the expenses, losses, incomes and gains. So nominal accounts examples can be purchases. I like to write on the board. I'm writing discount, DIS for discount, abbreviation, discount received, discount allowed, among which discount allowed is an expense and discount received is revenue. Then depreciation will also come under nominal account as it is an expense, though it is allocated to the asset. So depreciation will also come under nominal account, though allocated to an asset, but is an expense. And as it says, all expenses have a debit balance. Now, what are the rules regarding the personal and real nominal, combinedly known as impersonal accounts? Debit the receiver, credit the giver. Debit the receiver, credit the giver is the rule for the personal accounts. Now, I'd like to take an example for this. Now, how to debit the receiver? The receiver, or the one who is getting benefits from the actions of a business enterprise, shall be debited, and the one who is losing something, or the one who is giving the resources to anybody else within the firm, or the one who is having losses, or the one who is giving the financial resources during the working of the business enterprise, should be credited. Now, example, let's take cash paid to Ram. So here cash is being paid to Ram. That is, Ram is getting benefited. So Ram's account will be debited. So Ram's capital account will be debited by the amount to cash. Ram's capital account is being debited because Ram is the receiver of the cash. Ram is receiving cash from somebody. So Ram's capital account is being debited to cash. Now if we take the opposite example, that is Ram pays the cash. So this time Ram is paying the cash, that is he is foregoing the cash. So according to the rule of personal accounts, that is credit the giver, he is the giver this time because Ram pays the cash, clearly said by the statement. So it will be account debit to Ram's capital account. Ram's capital account will be credited. Now real accounts. Debit what comes in, credit what goes out. It says that the asset which is being received by the firm should be debited and the asset which is being foregoed or foregone by the firm should be credited. So let's take an example. For example, furniture purchased for cash. Now, what is being foregone and what is being coming in the business? Now, you tell me. Correct. Correct. Furniture is being coming, and cash is being foregone. So, furniture account will be debited because debit what comes in. Furniture account is being debited to cash account because cash balance is being deducted because we have paid for the amount of furniture purchased. For the amount, we have paid the amount for worth of which furniture is being purchased. So cash account is credited because credit what goes out. This was the real account. And finally, for the nominal accounts, debit all expenses and losses, credit all income and gain, for example, we take depreciation. So what should be the journal entry for depreciation applied to a machinery? Depreciation allocated to machinery. Depreciation allocated to machinery. It will be depreciation account debited to machinery. Being a mixture of the real accounts and nominal accounts journal entry, depreciation allocated to machinery. In this, depreciation account should be debited because of the rule of debit all expenses and losses, and machinery account is being credited because the machinery's market value is deducted due to a slight fall in its market price due to depreciation. So as complied by the rule, credit what goes out, machinery's account is credited. So depreciation account, that is debit all expenses and losses, to machinery account, that is credit what goes out. So these were the three types of traditional aspects of accounts. I hope you would have understood the traditional aspects of accounts and the basic compliances of various key terms used like assets, liabilities, capital, debit balance, credit balance, revenues and expenses. Thank you.